Africa, what happens when a government can't pay its debts? When the very same government that creates money, borrows your savings, and then taxes your income reaches its limits. A very crystal clear sign that government borrowing has gone a little bit too far. We call it a debt default. And when it happens, it's literally game over. In today's episode, we are going to discuss the devastating effects of a debt default, the early warning signs of it, and how you can best prepare yourself before the chaos begins. Welcome back to The Money Revolution, the podcast where we empower one another to build wealth through the sharing of information and ideas about how money really works. Now, I want to say a big shout out to our sponsor, Stokvel Gold. Stokvel Gold is an authorized dealer in gold and silver, registered with the Financial Intelligence Center. Stokvel Gold assists us with all of our silver and gold purchases at the lowest prices money can get you. Now, if you want to start your own gold and silver journey to, of course, expand your portfolio, hit the Stokvel Gold link in the description below and they will take good care of you. Here's a quick recap from Africa. Money is created when governments issue bonds. The institutions that buy these bonds from the government create new money out of thin air, thereby creating more currency in circulation. The repayment of these government bonds occurs through taxes. Now, every rand that you pay through your income tax, through your VAT and other levies is used to repay old government debt. It's pretty clear that your own hard work buys back the currency that was created out of thin air. And the side effect of all of that is, of course, inflation, the natural result of printing and borrowing by our government. What happens when a government defaults on its debts? Firstly, we need to understand who is it that actually borrows the government money. Roughly 75% of the South African government debt is held by local investors, whereas the other 25% is held by foreigners. Who are these local investors, you may ask? It encompasses your banks, your pension funds, and also your insurance companies. This means that your bank deposit, your retirement savings, and also that monthly car insurance premium is used to lend money to the government through the acquisition of these bonds. The money that is then used to repay these government debt comes from your own taxes. Now think about this. This means that the government is essentially borrowing from you and then they use your own future money to cover the payments of those debts that they make.
It's very technical.
I cannot believe it's true.
And remember, Africa, that this cycle only works as long as you, as the citizen, continues to put your faith and your trust in it. What really happens when a government defaults on its debts? A government default occurs when a government fails to make its scheduled payments on its debts. It's very much similar to a household that misses a mortgage payment or a car loan payment. But the consequences of a government default are far more reaching. Here is what typically happens. Access to borrowing becomes a little bit more difficult. And this is because investors lose confidence and are less willing to lend the government money, thereby making it harder to finance their own spending. The second thing that happens is that interest rates increase. Now, lenders usually demand more returns to compensate for the higher risk of lending to a country that fails to pay its obligations. The third thing that happens, and this is usually the route that most governments take to cover their own immediate expenses, they often increase the monetary supply, which then reduces the value of the currency that is in circulation. We've explained this trick way too many times. When more currency is put into circulation, inflation is inevitable. Thereby, the cost of goods and services will increase and the purchasing power of your savings will decline. The combined effect of all these four factors often leads to the following. Firstly, there will be a reduced spending by the governments on social services and other programs. The second thing that happens normally is that there is a rise in the levels of unemployment, particularly youth unemployment. The third thing that normally happens is that there is increased social and political tension. In short, a government default disrupts the economy and directly impacts the citizens' financial stability. The craziest part out of all of this is the fact that we've seen this story play itself out throughout history. In Greece, for instance, a rapid increase in government debt combined with weak economic growth triggered a huge financial crisis that affected many of its citizens. By 2015, the country defaulted on its obligations to the IMF. Banks then imposed strict limits on withdrawals, pensions were cut, unemployment soared, and the public service was under severe strain, leaving the ordinary families to bear the brunt of the crisis itself. Argentina experienced an even longer and even a much deeper struggle. Between 2001 and 2020, the country defaulted on multiple large debt obligations. Inflation repeatedly soared into triple digits, wiping out savings and destabilizing everyday lives of the citizens. Government austerity measures led to a widespread job losses, cut off social programs, and sustained civil unrest. And in both these two instances, the starting point was always the same. A debt that was growing faster than the economy, combine that with a public that trusted the system would keep working. Once that trust broke, the economic consequences were immediate, they were also very much visible and very painful. Let's be honest, Africa. South Africa has already shown signs of these specific cycle crises. Government debt has grown from 31.5% of the country's GDP in 2010 to a whopping 77% in 2025. Now, at the very same time, economic growth remains below 1% per year, whereas social spending continues to rise. Borrowing is becoming more expensive. Interest rates have steadily climbed and the tax revenue are under pressure as businesses continue to struggle to generate profits. The government has increasingly relied on money creation to cover their budget deficits, contributing to inflation that erodes everyday purchasing power of yours and mine. Now, this is a trend that we've explored extensively in earlier episodes of the Money Revolution around money creation, inflation, and also the hidden costs of government borrowing. All these many different pressures have already started to strain public services. Unemployment is at a record high, and there is social tension that is melting in the background. All these factors illustrate to us how the mechanisms of a default are not abstract. They are really unfolding in front of our eyes in real time. So protect your wealth with real tangible assets like gold, silver, and land. Strong relationships can also retain their value when the face of the economy collapses. Have you ever stopped to think what would happen if the government could no longer pay its debts? How would that impact you, your family, and your future? The real question here, Mo Africa, isn't if the system will face a breaking point. It's actually a matter of when, and whether or not you will be prepared when it happens. We want to hear from you, Mo Africa. How are you protecting your wealth? Are you considering gold and silver or other options to safeguard your own financial future? Please drop your comments in the section below and let's join the conversation. And once again, thank you for joining us on this episode of The Money Revolution. We encourage you to share this episode with your loved ones. And don't forget to hit the subscribe button and the notification bell so that you never miss out on any of our episode uploads. Let's wake up the masses. Let's understand how money really works and take back our power one conversation at a time. And remember, if it's paper, it will perish.